This Friday's job report just might flip the real estate market on its head. So here's what you need to know. The U.S. labor market is expected to show a slight cool down in July. This comes after a gradual slowdown in the economy and the havoc wreaked by Hurricane Beryl, especially in Texas. The Labor Department's non-farm payrolls report, dropping Friday at 8:30 a.m. Eastern Standard Time, is predicted to show payroll gains of 185,000. That's down from 206,000 in June, according to the Dow Jones consensus estimate. But some experts think it could be even lower. Goldman Sachs, for example, forecasts the hurricane might pull the number down to 15,000. That means we could see payroll gains closer to 165,000. Citigroup is even more pessimistic, predicting just 150,000 and a slight uptick in the unemployment rate to 4.2%. So why does this matter? Well, if the unemployment rate keeps climbing, we might trigger something called the SOM rule, which basically says we're in a recession if the unemployment rate averages half a percentage point higher over 3 months compared to the past year's low. So a year ago, we were at 3.5% unemployment. So we're keeping a very close eye on this. Fed Chair Jerome Powell recently noted that the labor market is coming into balance, with job openings now only outnumbering available workers 1.2 to 1 compared to 2 to 1 a few years back. And Powell hinted that if this trend continues, we might see an interest rate cut in September. So good news for borrowers, right? Maybe not. Markets are skeptical. You see, Wall Street wants the Fed to start easing rates right now, especially since inflation is nearly at the Fed's 2% target. DoubleLine CEO Jeffrey Gundlach even predicts we'll look back and realize we were in a recession by September 2024, which means he thinks we'll look back and we're in a recession right now. Yesterday, the Fed decided to hold its benchmark rate steady at 5.25 to 5.5% for now. So this sparked a rally, but gains were short-lived after news broke that unemployment claims rose last week and the manufacturing sector contracted even further. Average hourly earnings are also in the spotlight. The forecast is a 0.3% rise for the month and a 3.7% increase from last year. That's the lowest since May 2021. If wage pressures stay low, it gives the Fed room to cut rates, assuming other data cooperates. So what does this mean for you? For private real estate investors, a rate cut could lower borrowing costs, making it a good time to lock in mortgages or refinance. If you're eyeing new investments, keep an eye on this jobs report tomorrow, because it could signal the start of a more favorable borrowing environment, meaning it's something you may want to get ahead of before real estate prices start to rise again. Because when rates come down, you can bet that's what's going to happen. Stay tuned and let's see how this plays out. Until next time, keep your investments smart and your outlook positive.